Hi everyone, I'm John Zaller, CIO of MAI Capital, here with the latest edition of the MAI Market Update. This month, I'm excited to be joined by Nick Srmag, Senior Portfolio Manager and Chair of MAI's Fixed Income Committee, for a timely discussion around inflation, interest rates, and positioning portfolios as the Fed begins to tighten monetary policy. Nick, thanks so much for joining me today.
Thanks for having me today, John.
Well, at MAI, we view fixed income as the bedrock of a portfolio. It's the asset class that can preserve capital when the markets and economy are surprising to the downside, and can also be a source of reliable income for clients in their retirement years. But over the last few years, the level of interest rates and its decline, as well as the emergence of higher inflation, has created challenges for this long resilient asset class. So Nick, why don't we start there on the topic of inflation? Why is the rate of inflation so important for bond investors? And what is the market telling us today about the prospects for future inflation?
Sure. So certainly inflation is front of mind right now for both consumers and investors alike, particularly with the most recent headline CPI print for January coming in at a 7.5% increase year over year. And the last time we had to deal with inflation levels that high was actually back in the late 70s and early 80s. So it's not something the bond market has had to contend with for quite some time. Now, aside from the obvious erosion of purchasing power that comes with higher inflation, why is it important for bond investors? Well, all else equal, higher inflation can lead to higher bond yields, lower bond prices, and potentially negative returns in your bond portfolio. And that's exactly what we saw in January. The bond market got off to its worst start since 1980, falling over 2%. Now we have started to see some initial indications that inflation may be beginning to peak here in the US. Labor supply is slowly starting to come back online, and supply constraints are slowly working themselves out as well. And I'd say the bond market supports that assertion. If you look at longer-term inflation expectations, they've been steadily declining. And right now, the long-term inflation expectation is right around 2 to 3%. And I think that's a big reason why the 10-year Treasury yield's around 2% today. The bond market seems to be looking through these near-term inflation prints and pricing in a more normalized inflation environment over time. And don't forget, we also have the Fed getting ready to embark on its next rate hiking cycle, and all else equal, higher rates should mean lower inflation.
Well, that's a perfect segue into the next topic, which is the Fed. You know, when you think about the Fed and their messaging last year, they talked about inflation as transitory. They seem to have dropped that language from their messaging now. But the market's now having to adjust to a pretty significant rate hike cycle. So what are the market's expectations currently for the amount of rate hikes going forward? And how high do you think interest rates can actually go from here?
Sure. So right now the market's pricing in around 6 25 basis point hikes over the course of 2022, and then another 25 to 50 basis points in 2023. And that's a bit different from what the Fed is currently projecting. The Fed has been projecting a slower path of rate increases, although ultimately a higher terminal rate at 2.5%. And obviously, the rate at which inflation slows is going to dictate how quickly and how high the Fed needs to increase rates. But I think what we'll be watching very closely from a bond market perspective is what happens to the yield curve in that scenario. We've seen a really significant flattening of the curve over the last 12 months. And if the curve were to flatten further in the face of Fed rate hikes, that could potentially imply at some point that the market thinks the Fed is moving towards a policy error. And that could obviously have negative implications for the economic outlook. As for how high yields can go from here, I think back to the last rate hiking cycle where interest rates peaked at 2.5%. The 10-year Treasury yield got as high as 3.25%. And even though we're experiencing the highest inflationary prints that we've seen in literally decades, I still believe that some of those secular deflationary forces can continue to persist in our current environment today. And while there are risks to that outlook, we believe that as the effects of fiscal policy fade and monetary policy begins to tighten, that should put a similar cap on yields like we saw in the last hiking cycle. So essentially somewhere around 3% on the 10-year Treasury.
Well, Nick, in this type of environment where there's a stronger likelihood that the rates will continue to rise from here, how are we at MAI positioning bond portfolios?
Sure. So the primary way that we position for rising rates in portfolios is to underweight interest rate risk in our portfolios. The less duration sensitivity that you have in your bond portfolio means the less susceptible it is to the negative effects of rising rates. Now, we also advocate an overweight to credit-sensitive allocations, as they have a spread component or a yield premium that serves as sort of a buffer when rates are going higher. And more specifically, I think about floating rate bank loans in this environment. They actually have a coupon feature that resets as rates move up. So you're effectively stripping out your interest rate risk, and loans actually stand to benefit when rates are rising. And we also advocate an allocation to high yield bonds in this environment. The fundamental picture in the high yield space has been improving, and right now defaults are at all-time lows. Not to mention that high yield has historically performed well at the onset of Fed rate hike cycles. So those are just a few ways that we're currently positioning for higher rates in bond portfolios today, John.
Well, Nick, thanks so much for your insights today. And thank you to our clients for listening in. The next few years could present challenges for bond investors if rates do indeed move higher from here. But we also expect there to be opportunities for investors seeking a more competitive combination of reliable income and capital preservation. As always, our tactical views on the markets are a distant second to the strategic plan that your wealth advisor has constructed for you, taking into consideration your unique goals and objectives, tax situation, time horizon, and liquidity needs, among other things. As always, we count it a privilege to partner with you in this important aspect of your life, and we would encourage you to reach out to your wealth advisor at any time to discuss your portfolio in more detail. Thanks so much for listening, and we'll see you next time.